Welcome to the Deep Dive.
Right.
Today, we're taking a really wide look at the world of digital assets.
A very wide look.
We are spanning everything from, let's say, the extreme retail fringe all the way to the halls of the U.S. Treasury.
Right.
So our source material today is almost designed to give you whiplash. We're going from these super high-octane YouTube calls promising huge returns to sober institutional market reports and then landing on some very serious government risk assessments.
Exactly. It's a study in contrasts.
And that's really our mission today, isn't it? To sort of guide you, the listener, through these three really distinct worlds. We have to reconcile the pure hype, the speculative energy with the hard measurable data that big investors use, and then square that with the regulatory framework that's trying to manage all the risk.
So we have a great stack for you. We've got promotional stuff on hidden gems, deep analysis from big names like Coinbase and Glassnode, and that very detailed U.S. Treasury assessment on DeFi.
Let's just dive right into the deep end. Let's do it. We're going to start with what I'd call the highest voltage part of the market.
Yeah, the promotional side.
The content aimed directly at retail investors. This is the world of a channel called CKJ Crypto News, where the mood is just aggressively bullish.
To say the least. And the focus is all on tokens with what they claim is explosive potential.
Highly speculative, though.
Oh, absolutely. This part of the market, it really thrives on a combination of some kind of utility plus just massive, massive hype. A good example is the Zebec Network, ZBCN.
Okay, so what's the story there?
They're pushing it as the payroll and payments of the future. The core idea, the utility, is real-time streaming earnings.
So instead of a weekly paycheck, you get paid.
Every second you work. Imagine that.
And I'm guessing the price projections tied to this are pretty exciting.
That's what creates the buzz. They talk about the Zebec challenge, where someone bought 1 million ZBCN tokens for about $700.
Okay.
And that position quickly grew to a value of $7,000.
That's a quick 10x. That's the kind of thing that gets people's attention.
It absolutely does. And the key thing here is the promise they're making. The projection they offer you is, frankly, staggering.
Go on.
A $100 investment in ZBCN today gets you about 26,000 tokens. If the coin hits their target of $3,
$100 turns into $75,000.
Theoretically, it's the kind of number that it makes you stop and think about the sheer power of these volatile assets.
That's powerful.
Sure.
But it goes deeper than just utility tokens, right? You immediately get into pure meme assets.
Oh, yeah. Within ecosystems like the XP market, we're talking about names like CapZ, Hollow Model, AI Cat, and Stix. Stix. They market them openly as hidden gems. They even detailed a successful CapZ challenge where listeners could get 1 million tokens for just $24.
And what's that worth now?
Around $210.
So even on a meme coin, that's a significant return.
It is. But what's so fascinating is that this hyper-speculative energy is happening right alongside genuine institutional development on the exact same infrastructure.
You mean the XRP ledger?
Precisely, the XRPL. We just saw a new corporation, Evernorth, launch with a $1 billion funding goal.
$1 billion.
$1 billion, with a $50 million investment from Chris Larsen, Ripple's co-founder. And their whole purpose is to advance the XRPL ecosystem, its DeFi integration, using Ripple's new stablecoin.
So you have institutions coming in with $1 billion to build the highway.
While at the same time, you have people on that highway spending $24 to chase a huge return on a token literally named Stix.
Wow.
And what this contrast does is it forces the retail community, or at least the smart ones, to become skeptical.
They have to look for objective data.
Exactly. If you look at places like Reddit, the consensus is that most of these YouTube channels are just full of shilling, even things that look like pyramid schemes.
But that skepticism is healthy, right?
Yeah.
It pushes people to better sources.
It does. Instead of just hype, they pivot to real data.
So what are they using?
They're using DeFi to track total value locked, how much money is actually in a protocol. They use Developer Report to see which chains are actually being built on.
See who's active.
Right.
Yeah.
They use crypto fees to see which chains people are actually paying to use. And for the really professional on-chain analytics, they turn to places like Blockworks, Messari, and Kaiko.
It shows a real hunger for verifiable facts.
Which leads us perfectly into Bitcoin.
Okay, so let's trade that speculative frenzy for what many consider the bedrock of the whole industry, Bitcoin.
A big shift.
We're moving from the hype of meme coins to the hard money thesis, from assets whose value relies on marketing to an asset where the value is, well, engineered right into the code.
Engineered money is the perfect phrase for it. Because Bitcoin scarcity is absolutely fixed. It's not like gold, where you could discover a new mine or develop better mining tech.
Bitcoin supply is driven by these two unchangeable forces in the protocol. So let's just do a quick refresher on those for the listener. First up is the halving.
The halving is simple, but incredibly profound. Roughly every 4 years, the reward that miners get for validating a block of transactions gets cut in half.
Which does two things at once.
Exactly. It reduces the new supply coming onto the market, but just as importantly, it instantly doubles the cost of production for every single miner to get one new Bitcoin.
And that constantly rising cost base is a huge part of the hard money narrative.
Massive driver. And then there's the second mechanism, which is maybe a little less understood.
The difficulty adjustment.
The difficulty adjustment. It's the system's self-correction mechanism. Bitcoin is designed to produce a new block every 10 minutes, like clockwork.
Okay.
So if a whole bunch of new, very powerful miners join the network, that increases the overall computing power, the hash rate.
And blocks would start getting found faster than 10 minutes.
Precisely. So roughly every 2 weeks, the code looks at the speed and adjusts the difficulty of the mathematical problem. It makes it harder to mine.
All to keep that 10-minute block time steady.
Exactly, which constantly increases the security and the energy cost of the network.
And that guaranteed scarcity and security, that's what fuels these really serious predictions, like the $1 million price target by 2028.
Absolutely. And you can see that confidence in how institutions are starting to treat Bitcoin, not just as something to buy and hold, but as actual viable collateral.
We're even seeing new products designed specifically to handle its famous volatility.
Yeah, we looked at one from People's Reserve, which is designed to mitigate that catastrophic liquidation risk.
So how does that work? How do you let someone hold onto their Bitcoin even if the price suddenly tanks?
It's pretty clever. It creates a disincentive for an immediate fire sale. So instead of liquidating the collateral the second it hits a certain price, the interest rate on the loan goes up by 50 basis points for every 10% the price of Bitcoin drops.
So if you borrow against 10 grand worth of BTC and it drops to 5 grand, a 50% drop, your interest rate jumps up 2.5%.
Yeah, right. But you still have your Bitcoin. You get to weather the storm and wait for a recovery.
But doesn't that make the loan incredibly expensive? Is that a real long-term solution or just a way to kick the can down the road and avoid a sale right now?
And that's the core tension. It is expensive, but its purpose is to fundamentally change how Bitcoin is classified as collateral.
I see.
For a big institution, avoiding a forced liquidation during market stress is everything. This kind of innovation helps shift Bitcoin's perception away from just being a risk-on tech stock, which is how old-school banking sees it.
And toward being a durable collateral asset.
Yes. Because Bitcoin is completely traceable back to its first block, it's arguably more audible than cash, which really challenges that traditional risk perception.
And the institutional data seems to reflect this change in attitude.
The Coinbase and Glassnode reports really quantify it. They talk about these digital asset treasuries, or DATs.
And the scale of these is pretty big now.
The scale is massive, and it signals a long-term commitment. These DATs now collectively hold about 3.5% of the total circulating Bitcoin supply.
Wow. And it's similar for Ethereum.
Nearly identical. About 3.7% of the Ethereum supply. This isn't just retail speculation anymore. This is institutional balance sheet strategy.
And their outlook, looking into late 2025, seems pretty positive.
Cautiously optimistic, I'd say. 67% of the institutions they surveyed had a positive outlook on Bitcoin.
What's driving that?
It's mostly macro expectations. They're anticipating Fed rate cuts and favorable conditions in the M2 money supply, the amount of money circulating in the economy.
But there was a note of caution in there.
There was. The data pointed to a potential tightening period for M2 around November, which suggests we should still expect some volatility.
Okay, so given all this institutional buy-in and these clever new products, what happens when the regulators turn on a very bright, very focused spotlight?
That's where things get complicated. We shift now to the U.S. Treasury's risk assessment, which is, it's a stark dose of reality.
And what's the headline finding?
The main finding directly challenges the industry's favorite buzzword. The Treasury says that DeFi is often decentralized, more in name than in fact.
That's a big claim. How do they back that up?
They point to all these persistent points of centralization. They talk about the governing organizations behind the protocols, the concentration of voting power in just a few wallets that hold all the governance tokens.
And the developing.
And the critical reliance on that core group of application developers for all the maintenance and upgrades. All of these are centralized pressure points.
Which makes it hard for a project to claim it's truly decentralized and therefore somehow exempt from regulation.
Exactly. And that leads to the core vulnerability the Treasury is focused on. The failure to comply with Anti-Money Laundering and Bank Secrecy Act rules.
AML, CFT, and BSA.
Right. The regulators are being very clear. If your service performs financial activities like money transmission, it doesn't matter if it uses a smart contract or a DAO, the Bank Secrecy Act obligations still apply.
And have we seen projects actively trying to get around this?
Oh, absolutely. The report explicitly references examples like Shapeshift and the founders of Uki DAO.
What do they do?
They openly tried to transition their companies into DAO structures, specifically to argue that there was no centralized entity left that was responsible for complying with AML rules.
So they were trying to exploit that ambiguity.
And this kind of avoidance is what fuels the illicit finance risk.
So who are the main bad actors leveraging these gaps?
The list is pretty sophisticated. Ransomware criminals, fraudsters, thieves, and maybe most importantly, state-sponsored actors.
Like the DPRK's Lazarus Group.
The Lazarus Group, exactly. They've financed their country's weapons programs with billions of dollars stolen through massive crypto heists.
And the techniques they use for laundering are pretty advanced too. They're basically using DeFi's best features against itself.
Completely. Their main methods involve chain hopping. They use cross-chain bridges and decentralized exchanges, DXs, to move assets across multiple blockchains at lightning speed.
Which makes them incredibly difficult to trace.
And they also use mixers like Tornado Cash, which of course was sanctioned by OFAC after it was used by North Korean actors to launder hundreds of millions in stolen funds.
So the government is definitely taking enforcement action.
They are. You have high-profile cases like the CFTC charging Uki DAO for failing to comply with BSA requirements. That's a clear signal.
That claiming decentralization is not a get-out-of-jail-free card.
Not at all. And then you also have these devastating manipulation attacks. The Abraham Eisenberg case is a perfect example.
The Mango Markets exploit.
Right. He manipulated the price oracle for Mango Markets and fraudulently drained over $110 million in digital assets. It just shows how vulnerabilities in the code itself can create catastrophic risk.
Okay, let's pivot back to the institutional data for a moment. Because it seems like the market is maturing and solving some of these problems, especially around cost, which has been a big barrier.
Yeah, if you look at the latest data, especially around Ethereum, you can see efficiency is improving really, really fast. And for institutional players who need predictable, low-cost transactions, that matters a lot.
We did see a curious data point for Q3 of 2025. While institutions are invested in both Bitcoin and Ethereum, ETH ETFs actually saw more inflows.
That's right. $9.4 billion for ETH ETFs compared to $8 billion for BTC.
Why is that?
It's often tied directly to performance and cost. In that same quarter, transaction volume on ETH and its Layer 2 solutions hit new highs, but at the same time, the average user fee fell to a 2-year low.
So the scaling solutions are actually working.
It's the clearest evidence yet. On-chain activity is getting significantly cheaper, and that makes it much more attractive for large-scale use cases.
Lower costs mean more utility, which could also help with the regulatory concerns about tracking millions of tiny, high-cost transactions.
Absolutely. But the scaling success is also happening alongside some interesting shifts in investor behavior.
How so?
Well, Bitcoin's illiquid supply stayed really high, meaning the long-term holders were not selling.
Diamond hands.
Diamond hands, exactly. But Ethereum's liquid supply increased by 18%.
So long-term ETH holders were selling.
It suggests that some of them were comfortable taking profits into that rally. It shows a different kind of psychological expectation between the two biggest assets.
Okay, this brings us to what might be the weirdest data point we found. A genuine disconnect hidden in the sources. The CKJ disconnect.
Right.
We started this whole deep dive talking about CKJ Crypto News, this super speculative YouTube channel. But we also found a traditional financial analysis document using the exact same ticker.
The ticker DBCKJ. It actually belongs to a German-listed company called ClearVue Technologies Limited. And the analysis is completely dry, traditional finance.
Market cap of about 27 million euros. A very conservative debt-to-equity ratio.
4.4%.
But then there's this alarming little nugget in the data. The cash runway.
Even after raising more capital, the analysis estimates this publicly traded company has a cash runway of only 4 months.
So here's the puzzle for you, the listener. You have the simultaneous existence of these two completely separate realities sharing the same ticker symbol.
On one hand, you have this promotional crypto content screaming about turning $100 into 75 grand.
And on the other, you have traditional finance quietly worrying about a company that might run out of money in 4 months.
It perfectly summarizes the chasm between the dizzying speed and risk of the crypto world and the slow, grinding reality of traditional corporate finance.
So what does this whole spectrum teach us? Where does this leave us?
I think it shows that the digital asset space just exists under this constant extreme tension. You have the promises of radical, life-changing returns on one end, the ZBCN and the CAPZ calls, and that's constantly fighting against the increasing gravity of institutional finance and, of course, regulatory enforcement on the other.
And the regulators are not backing down.
Not at all. The Treasury has made it very clear that they intend to close these Bank Secrecy Act gaps related to DeFi disintermediation. Compliance is inevitably going to catch up to the innovation.
So here's the final provocative thought for you to chew on. We've seen pretty clear evidence that centralization persists even in these so-called decentralized projects.
Through governance tokens, admin keys, core developers.
Exactly. We also know that the very code designed to secure your assets, the smart contract, can be exploited for $100 million theft like we saw with Mango Markets. So if regulators are going to insist on finding a centralized party to hold accountable, does true, secure, and safe decentralization remain a practical ideal? Or is it slowly becoming an impossibility in the world of high-stakes finance?